Hey everyone, welcome to our channel. Today, we're diving into a topic that every aspiring investor should understand: building a diversified portfolio. Whether you're new to investing or looking to enhance your strategies, understanding diversification is essential to managing risk and maximizing long-term gains. Stick around for actionable tips, and don't forget to subscribe and hit the notification bell for more investment strategies.
In this video, we'll break down exactly what a diversified portfolio is, why it's crucial for your financial success, and how to create one that works for you. Stick around for actionable tips, and don't forget to subscribe and hit the notification bell for more investment strategies.
What is a diversified portfolio?
A diversified portfolio is a collection of different investment stocks, bonds, real estate, and sometimes even alternative assets like cryptocurrencies or commodities. The goal of diversification is to spread risk. If one asset class underperforms, others may do well. Balancing out your losses, it's like not putting all your eggs in one basket. Risk management and ROI. Risk management in investing involves identifying and minimizing potential losses while aiming for financial growth. Investors use strategies such as diversification, where they spread their investments across various asset classes, stocks, bonds, real estate, to reduce the impact of any single investment failing. By diversifying, risk is distributed, helping to manage the unpredictability of the market. Return on investment (ROI) measures the profitability of an investment. It's calculated as the gain or loss made relative to the initial cost of the investment. For example, if you invest $100 and make $120, your ROI is 20. If you have not subscribed to our channel, please like, comment, share, and subscribe. Thank you. How diversification works in practice. Diversification protects against market volatility by ensuring that different assets perform differently under varying conditions. For example, during the 2008 financial crisis, stocks experienced significant losses, but assets like government bonds and gold held their value or increased, helping a diversified portfolio recover faster than one invested solely in stocks. In 2020, during the COVID-19 pandemic, tech stocks surged due to increased digital activity, while sectors like travel and retail suffered. A diversified portfolio with exposure to tech, bonds, and real estate would have balanced these fluctuations more effectively than a concentrated portfolio. Key points. Diversification reduces risk by spreading investments across various assets. ROI helps measure how well an investment performs in terms of profitability. ROI helps measure how well an investment performs in terms of profitability. Historical data shows diversified portfolios often recover faster from market downturns.
Why is diversification key for financial
Diversification
success?
helps you reduce the overall volatility in your portfolio.
While no investment is risk-free, a well-diversified portfolio allows you to manage risk more effectively.
This doesn't mean you won't experience losses, but it helps to minimize the blow during market downturns.
What is diversification?
Diversification is the strategy of spreading investments across different asset classes like stocks, bonds, and real estate. The idea is simple. When one market dips, others may rise or remain stable, reducing overall risk. Market volatility and risk protection. Markets experience ups and downs, but diversification helps balance the risks. When one sector struggles, another may perform well, minimizing potential losses. For instance, during market downturns, safer investments like bonds or gold often rise in value while stocks fall, stabilizing your portfolio. Historical examples: 1. 2008 financial crisis. During the global financial crash, many stocks plummeted. However, government bonds and gold remained relatively stable or increased in value, helping diversified portfolios recover faster compared to those concentrated solely in stocks. 2. 2020 COVID-19 pandemic. As tourism and retail stocks crashed, tech stocks like Amazon and Zoom surged. Investors who diversified into tech benefited from the rapid recovery in digital sectors. In summary, diversification shields your investments from market crashes by balancing risk across different asset classes. It's a time-tested strategy to ensure long-term growth and minimize the effects of volatility. If you're building a portfolio, always aim for diversification. Types of assets to include in a diversified portfolio. Are many different types of assets you can include in your portfolio. Let's explore the most common ones. First, we have stocks, which represent ownership in a company. Stocks have the potential for high returns but also come with higher risk. Then, there are bonds, a safer option that provides fixed income. Next up is real estate, investing in physical property or through REITs, real estate investment trusts. Lastly, there are alternative assets like commodities and even cryptocurrencies if you're comfortable with more risk. Choosing assets based on risk tolerance. Risk tolerance is key in shaping your investment strategy. If you have a low tolerance, you may prefer safer assets like bonds or cash, which offer lower returns but less volatility. On the other hand, those with high risk tolerance might invest in stocks or cryptocurrencies, which are more volatile but offer higher returns. Examples of balanced portfolios. Conservative portfolio. 1. 60% bonds. 2. 30% cash. 3. 10% blue chip stocks. Moderate portfolio. 1. 50% stocks. 2. 30% bonds. 3. 20% real estate. Aggressive portfolio. 1. 70% stocks. 2. 20% alternatives, for example, commodities. 3. 10% bonds. Balancing risk tolerance with asset selection ensures that you're comfortable with market fluctuations while still working towards financial growth. Steps to build a diversified portfolio. Now, let's get practical. Here's how to build a diversified portfolio step by step. Assess your financial goals. Are you investing for retirement, a major purchase, or general wealth building? 2. Determine your risk tolerance. How much risk are you comfortable with? Determine your risk tolerance. How much risk are you comfortable with? Allocate your assets. Based on your goals and risk tolerance, Decide what percentage of your portfolio will go into stocks, bonds, real estate, etc. 4. Research and choose specific investments. Whether you're picking individual stocks or ETFs, do your homework. 5. Monitor and rebalance. Markets change, so check your portfolio regularly and adjust as needed. When choosing between mutual funds and ETFs for easy diversification, consider these factors. Costs and fees. ETFs generally have lower expense ratios and fewer fees than mutual funds, making them more cost-effective for long-term investments. Trading flexibility. ETFs can be traded like stocks throughout the day, while mutual funds are only traded at the end of the day. Minimum investment. Mutual funds often have higher minimum investment requirements, whereas ETFs can be purchased per share, making them more accessible. Tax efficiency. ETFs tend to be more tax efficient due to their structure, as they incur fewer capital gains taxes. Both options offer diversification, but ETFs may be preferable for low costs and flexibility, while mutual funds can be beneficial for structured, managed portfolios. Common mistakes to avoid. Diversification is crucial, but there are common mistakes that investors make. One big mistake is over-diversifying, which can dilute your potential returns. Another pitfall is failing to rebalance your portfolio. This can leave you too exposed to certain asset classes as markets fluctuate. Lastly, avoid the trap of emotional investing, letting fear or excitement drive your decisions instead of long-term strategy. Avoiding chasing trends and the dangers of portfolio complexity. Avoiding trend chasing. Chasing investment trends, like buying into hyped assets, for example, meme stocks or cryptocurrencies at their peak, often leads to poor long-term results. These trends are typically driven by short-term market sentiment rather than sound financial fundamentals, causing inflated prices and potential losses when the bubble bursts. It's better to focus on time-tested investments and long-term strategies, rather than attempting to capitalize on the latest fads. Dangers of complexity. A portfolio with too many asset types, sectors, or regions can become difficult to manage and track effectively. Overcomplicating your portfolio can lead to higher costs, increased risk of overlap, and less clarity on performance. It's essential to maintain a well-diversified but manageable portfolio that aligns with your financial goals and risk tolerance without introducing unnecessary complexity. By sticking to a well-balanced, diversified strategy, investors avoid the pitfalls of chasing hot trends, and keeping their portfolios simple ensures better control over performance and risk. Building a diversified portfolio is one of the most important steps you can take to secure your financial future. It helps balance risk and reward, and ensures you're prepared for the ups and downs of the market. Take the time to assess your financial goals, research different asset classes, and stay disciplined in your approach. Thanks for tuning in today.